Well, I got bad news for these people, especially if you're 27 years old and you got $3,000. If you're lucky to your name, you cannot buy a home at $550,000 with $3,000 down and a bunch of NFTs. Because the people who are going to be competing against you to buy that house, hopefully on the cheap, even if there is a crash, and ooh, do they want it? It's going to be institutions that pay cash. And if the Federal Reserve expands its balance sheet again and goes to 10 or 12 or 14, and they're going to, at some point, 26, maybe 27, who do you think eats at the trough first? We are now in an environment where the central bank has repeatedly engaged in a combination of two things. First is consistently and constantly providing liquidity to the system in order to prevent price spiraling. That is effectively to prevent deflation. So the fear of deflation in 2008 helped fuel a dramatic expansion of the Federal Reserve's balance sheet up to $1 trillion. Today we're at $7.5 trillion. And I am willing to bet that we will hit 10 before we hit 6.5. Because I don't know who the hell wants to buy U.S. bonds right now. Japan is going to likely be peeling away, and China has been dumping. So if they're not the buyer and the American people don't have enough money to buy, who does? Well, it's the Fed. And if that's the case, and they start to engage in the zombification of what is happening in the Bank of Japan, the Bank of Japan owns more than half the bonds in Japan. They also own a shoot ton of equities because of their ownership of ETFs, roughly 7% of equities in Japan. Now, if they continue that course, Japan will effectively, the central bank will have accomplished things that the East Germans could have only dreamed of post 1945, and that is real ownership of the economy. Which brings me to this. The Federal Reserve expands its balance sheet. What have we seen transpire over the last decade that is so dangerous for the United States economy? That is the rise of pacification in the system of the equity markets. Now, as I noted, you see the Bank of Japan buying up ETFs and buying up equities. Here we don't have that. Here we have capitalism, but it's not capitalism. It's BlackRock, Vanguard, and State Street buying every damn thing under the sun, because as money spills out of the central bank, it finds its way into, oh, that's right, the high institutional banking level. They are the first people to eat out of the trough. And as a result of that, BlackRock's AUM has expanded from 4 trillion to 11 trillion over the last few years. 15 trillion between Vanguard, State Street, and BlackRock. And while this was happening, this sell-off, while everyone was panicking about higher interest rates, the institutions were stepping in and buying the whole time. Stepping in and buying, playing on the fear of the market, expanding the amount of assets that fall into the passive pool. And one of the things that happens as a result of this is it bastardizes price discovery and valuation. As you know, BlackRock does not give a damn about the price of some of these companies that they brought public a couple of years ago. Snowflake's a great company in this little kind of example. Snowflake still trades 24 times sales. It's completely unprofitable. And when it went public and it was up here at 330, BlackRock owned a ton of it. And they just put them into ETFs, cybersecurity ETFs, future AI ETFs, AI technology ETFs, name it. Snowflake's probably in, I don't know. I'm going to make a guess that they're in 73 ETFs. 138. Wow. I was way off. Okay. What does that tell us? 158 ETFs own a company trading at 20 times sales that is not profitable. What? 30 years ago, this would not have been happening. But there is a market for these ETFs. There is this market for this exposure. They sell this stuff to pension funds and to colleges and to everybody else who's like, oh, you know what? I really want to be invested in the Future Tech Leaders Equity ETF. Let me get in on that at New York State Life so that when every moron who signs up for a 401k goes, oh, I want to invest in future technology, not even looking at what is in it and what the valuations are on any of this crap, this thing is ultimately provided to those dum-dums. And then they watch as their 401ks fall in value during this period, right? That sell-off. And all that ends up happening is all these other players just say, I want to get in on this game. And all this stuff pops up. I mean, I couldn't tell you what half this crap is. All I know is that we continue to see, this is the filing date of when these companies started adding Snowflake. And if you look at it, they were buying it this year down at these specific levels. When this was getting beaten up, they were buying it in March. They were buying it in April. It's insane. And if I had an upgrade on this, I could go back and I could show you their buying patterns in 2020 while everything else was selling off. Now, why does that matter? Well, it matters because they're owning everything. They're buying up all of this stuff, and you can actually see it in the Form 4s because all of that stuff has to be filed. And ultimately, what you end up with is a ton of ETFs that simply and will not dump any of this. Some of the things that they can do, let's get the insider, look at the amount of buying, the institutional buying of this stuff. Lots and lots of holding. Now, some of these funds, these like more active funds, are dumping this crap. Why? They're taking gains off of what's happened to start the year. But there was a lot of buying here, and a lot of ETFs were stepping in and buying this stuff. Now, on top of that, this is where you're going to see all the Sequoias, Iconics. Okay. So now there is this institutional support for all of these a stock like this. It's in the Renaissance IPO ETF. It's in the Exotica NG. They don't have to sell this stuff. In fact, they're making money on fees. They don't care. They allocated their investors' capital. They built these ETFs, and now they sell into the market, and all of these funds are buying them. Pension funds, international insurance names. Now, why does that matter? Because this stuff will not get dumped unless they are forced to sell it. And that is known as forced buying or forced selling. We've had two major bouts of forced selling in the last 11, 13 years, the last 15 years. 2008, massive credit event. 2020, massive downturn in the market because of an expectation of a decline and collapse in productivity and the economy. So barring some major credit event, none of this stuff's getting dumped. The outstanding shares, yeah. Equity players will allow this thing to bounce, but as liquidity has expanded since October, this thing has started to move higher. Valuation be damned. And when momentum is positive, turns positive, this crap rallies. I don't know why. I don't care. Short squeezes. Like, people actually think that BlackRock's going to sell all their Snowflake because the market is going lower. Like, they're shorting. BlackRock is lending the stock for short sellers to short. Why does all of this matter? It matters because of one quote that came out today. If pacification is not enough of a concern for you, about the state of the equity market, then consider this quote. This comes from MetLife Investment Management, and it came out today. Institutional investors may control 40% of the U.S. single-family rental homes by 2030. It's not enough to control the cash flows of the equity market. They're coming for the rest of the middle class. They're coming for the only thing that gives people any level of dignity when they die, and that is living a good life, having a nest egg, being able to leave something behind. Most people's assets, most people's wealth is in their home. And if this is the case, millennials are done. Gen Z's never getting anywhere. And if they expand the balance sheet, and there is a housing correction, I've got every idiot on Twitter trying to argue with me on housing right now. The bottom for housing was in October. And how do I know that? Because the Fed pivoted on mortgage-backed securities. And you don't have to look any further than KBH right now and see, oh, yeah, KB Homes. That stock has gone from 26 to 54. And everybody talked about how housing was going to go down. Here's the issue. There may be another housing crisis. It likely is not going to be driven by 7-8% interest rates. It's going to be driven when interest rates fall and people panic, or people think, hey, you know what? It's time to sell. It's time for me to move. And you got a whole host of people saying, that's going to be the time for me to buy. Well, I got bad news for these people, especially if you're 27 years old and you got $3,000. If you're lucky to your name, you cannot buy a home at $550,000 with $3,000 down and a bunch of NFTs. Because the people who are going to be competing against you to buy that house, hopefully on the cheap, even if there is a crash, and ooh, do they want it? It's going to be institutions that pay cash. And if the Federal Reserve expands its balance sheet again and goes to 10 or 12 or 14, and they're going to, at some point, 26, maybe 27, who do you think eats at the trough first? When they say you will own nothing and be happy, this is the cannibalization. It is a broad institutional takeover of everything, everywhere. It is the equity market. It is the housing market. It is the energy market. They are speeding toward this. And the reason that they can is because of the goddamn central bank. The central bank continues to try to provide support to the economy. The fiscal expansion continues to try to provide support to the economy. The supply side focus is non-existent. Now, this will go until it breaks. But the next decade, people they're coming for the equity, the ability for people to build equity. They are ripping that down. And it's over at that point.